It's very rare to see income focused ETF, especially cover call ETF like a QMAX here, that performs actually better than the index itself. In this case, it's a Nasdaq, because this QMAX is technology ETF, and we are comparing that to the Nasdaq 100. And in this case, we're using Canadian ETF, which is XQQ. So before I go deeper and show you all the performance from the inception of this one, I'm going to give you a couple good news about the QMAX and then see if it's the right time for you to invest. But if we look at the 3 months, we can see right now the QMAX has outperformed the Nasdaq 100. So that's something very strange. So before going back to the chart and see the performance since inception and see the price and all the yield right now, we can for people who don't know what QMAX is, we can go and you know, and explain what it is. So Hamilton Technology Yield Maximizer ETF, as they say here, is high income from US tech leaders, right? So these are technology companies, pretty much AI company. You see the position of these ETFs. So the highlight of this fund is exposure to largest technology company in the US, okay, and then he achieve its you know, its strategies by using, of course, cover call, and they use active management. So it's a good fit for any investor who is looking for high income and also for tax efficient, and also for modest long-term growth potential from US tech companies, and to reduce volatility from option strategy, because they use option strategy, so they're gonna reduce volatility than you actually owning the stocks themselves. If we look at the investment objective, of course, QMAX is designed to attract monthly income while providing exposure to portfolio primarily large cap from the US technology companies, and of course to reduce volatility, and of course to give you the income from active cover call strategy. And of course it does not use leverage, because other ETFs, they use leverage to enhance that, but this is not enhanced one, so they don't use leverage. If we look at what makes QMAX difference, okay, money cover call ETF write option out of the money. This QMAX actually, it doesn't do that. It does it provide high income by writing at the money option strategy. And of course, also QMAX write option on 30% of its holding only. So it doesn't utilize all the position they hold, only 30%, and they keep 70% for growth. And that's why we see in upcoming you know, chart, I'll show you why it has outperformed pretty well. If we look at the holdings that they have Nvidia, they have AMD, Meta, Broadcom, Netflix, Amazon, Qualcomm, Intuit, Microsoft, Texas Instrument, Google, Apple, Intel, Adobe, and Tesla. So pretty much most of these companies, they are the companies that are leaders in AI. So boy, can say it's literally AI you know, ETF, you know, if you want to say that. But we look at management fee is 65, because this is very important, because you're not paying as much, but you're not paying as low as other you know, just plain vanilla index, and they do rebalance semi-annually. And if you look at currency hedging, it does not hedge anything, because when you buy your Canadian dollar, and of course you just invest as it is, but you don't have to worry about you don't have to worry too much about currency hedging, because there's overall it doesn't really provide any you know, benefit as much as you might think. And if we look at the way it's traded, is Toronto Stock Exchange. Inception was October 25th, 2023. So it's been around for, you know, about more than 6 months. If you look at investment style, is US technology company. So far they have accumulated about 261 million, so about 3 million. Of course, they're selling and buying. So it's a pretty, I mean, 200 actually, not 3, sorry, almost 300 million it has accumulated. So that's it's a great, because the bigger the money you have, the more you can do with the option and buying, and more power you have for any ETF. When we look at distribution, we can see here they've been paying dividends since it was incepted. So the first time they paid was in October. In October, I mean December. The announcement was in October, but they did pay on December 7th, and it was 18 cents. In January they pay 18 cents. In February they did pay 185, so there was a little increase there. In In March, they did pay about 19 cents. There's also increase. So that's a pretty good when you can see it keeps increasing rather than reducing its dividend. If we look at the chart first, we can see Hamilton Enhanced Technology Yield Maximizer ETF QMAX. Look at this chart, how it looks. It's a pretty healthy chart, right? And it's just a growth from where it started from $16. You keep going up. The yield, remember I told you he paid about 19 cents. So if we divide 19 by that 1972, and in terms of 100, we're getting about 11.65%. That's a yield right now. It yields about, so it's a pretty good, almost 12%. I mean, there are two compelling reasons why you would want to buy this ETF. First would be the growth of it, because you are buying this not only for income but also for little growth because it's tech. But the difference between these and others is because look at this. If you look at this one, it within 3 months actually has outperformed the index, right? This is an index, broader technology index, has 100 stocks. Of course, this one has only about 15 position, but mainly AI stocks. So, but if you look at that 1 year, this iShare has returned about overall about 11.50%. So within a year, this one, year to date, the QMAX has outperformed the Nasdaq itself, because this is literally representative or representing Nasdaq 100. So which is the tech, mainly tech ETF. So if we look at Max. If we look at the max, though, if we go 6 months, of course, the QMAX has outperformed. When you look at the 1 year to date, QMAX has outperformed 12, it says 11. But don't forget, there's also dividend on top of that. So there's more than that. But if we spread all the way to just max, we can see here, we can see the Nasdaq start outperforming the QMAX by is a 20. And here you get 17.59. So the two reasons why this would be more than this one. First of all, there's a more fee on this one versus this one. That's one reason. This one is only 0.25 basis point. This is 0.65 basis point. And other fee altogether will be almost 1%. Or 95.95. So you're getting a hit by fee there from this one ETF. But here's the thing, this chart just includes the growth of the stock itself. It does not include dividends. So if we take dividends, we put back on there, your QMAX actually is doing pretty the same as QQQ. So that's very important news to know. That's one of the reasons why you'd want to pick this ETF. And the other reason I like about this one, they only write call on 30 and then they keep 70% for growth. So that's a really good strategy. Right here, is it going to outpace performance as it did within a year to date? That's to be seen. Till we meet again next video, just make sure to subscribe. Bye bye.